collapsing, but the stock market is extremely volatile and the interest rates are high. So the question is, if we are not in a real recession according to the National Bureau of Economic Research, then why the hell is everyone panicking? Well, that is because there is one chart that has predicted every major US recession in the past 50 years. And right now, this chart is screaming danger. This is called the yield curve. And look at this. Every single time, I repeat, every single time it has inverted, a recession has followed. In 2007, the yield curve inverted and the financial crash hit in 2008. In 2000, the yield curve inverted and the dot-com bubble burst. In 1969, the yield curve inverted and recession struck in 1970. In 1973, the yield curve inverted and another brutal recession hit the world. And now, the yield curve is almost about to get inverted. So, two questions. What the hell is a yield curve and how does it predict a recession? Well, let's understand this using a story. Let's say the government needs a 1 crore rupee loan for 3 years. So it issues a bond of 100 units with each unit costing 1 lakh rupees with a 3-year term and a 2% interest. So if you buy 1 unit of this bond, the government will pay you 2,000 rupees in year 1, 2,000 rupees in year 2 and 2,000 rupees in year 3. And after 3 years, after using this money, you will get back your 1 lakh rupees. Sounds simple, right? But now comes the tricky part. Most people think yield is just another word for interest rates. But that's not the case. Look at this. Here's the difference. Interest rate is fixed by the government. So when the bond is issued, the government fixes the interest rate. In our example, it's 2% per year. So no matter what happens in the market, this 2% will not change for those investors who bought the bond directly from the government. But if you look at yield, it changes based on market demand. And here's where things get very, very interesting. Let's say you bought the bond for 1 lakh rupees at a 2% interest rate. But suddenly the government issues a fresh bond with an interest rate of 5%. So now nobody wants to buy your 2% bond because they can get a fresh bond with 5% interest instead, right? So if you try to sell your bond before 3 years, you cannot sell it for 1 lakh rupees. So you will have to lower the price to attract buyers. Now let's say you sell it for 50,000 rupees. Now the new buyer will still get 2,000 rupees per year, which is the fixed interest rate. And since they only paid 50,000 rupees, their actual return, as in their yield, is 2,000 rupees divided by 50,000 rupees into 100 equal to 4%. This is called a yield. And if you see the yield of this bond, the yield just shot up from 2% to 4%. So now the interest rate is still 2%, which is fixed, but yield is 4% because the buyer paid less for the bond. This means when bond prices go down, yield goes up. And if you've understood the difference between yield and interest, let's talk about what's happening right now in the US and why should India pay attention. You see, in a healthy economy, investors are very confident of the future. So long-term bonds get high yields and the short-term bonds get low yields in the market. So if you buy a 1-year bond, you might get a yield of about 3%, whereas a 10-year bond might offer a 5% yield. Now this is normal. So if you plot the yield of a 3-year, 5-year, 10-year and 30-year bond, it creates an upward sloping yield curve. Meaning, the longer you invest, the higher the yield. But then you know what guys? Something changes when recession comes closer.
President Donald Trump's tariffs have spooked investors, wiping out $4 trillion in market value. Amid the fears of recession and an economic downturn, investors are pulling out of the American stock market.
Chairman of the Federal Reserve announced on Wednesday that the Fed is again raising interest rates to combat inflation.
The economy is heading toward a recession. The stock market is tanking and people's costs keep going up.
When the inflation is high, when the interest rates are rising, when companies are struggling, stock markets start crashing. And this is when the investors get scared. So now, instead of keeping their money in the stock market, they rush to buy long-term government bonds because they are safer. But here's the twist. They don't trust the short-term future of the economy, so they avoid buying 1-year bonds. Instead, they rush to buy long-term bonds like 10 years or 30 years bond. And this sudden demand for long-term bonds pushes the prices of these long-term bonds up. And when the bond prices go up, what happens? The yields go down. At the same time, because very few people are buying short-term bonds, the prices of these bonds starts falling. And when the bond prices fall, the yields go up. And this is where the yield curve inverts, because now the bond market looks like this. 1-year bond is giving out 6% yield, which is higher than before, and 10-year bond is giving out a 4% yield, which is lower than before. And here's where the yield curve inverts. Now look at this. The yield curve is almost about to invert. The 1-month bond yield is already higher than the 6-month yield, the 5-year yield, and even the 10-year yield. And the 3-month yield is higher than the 5 and 7-year yield. Usually, if the 3-month yield is higher than the 10-year yield, recession is expected to arrive. This is one of the biggest recession warnings in the financial world, because like we saw, in the past 50 years, every time the yield curve inverted, recession followed. Now, the reason why this is surprising is because when Trump came to power, everything seemed like a fairy tale in the market. Investors were optimistic, businesses were expanding, and the Wall Street was celebrating. But then everything started to change.
Stock market closed out the week with the worst day of the year so far. The NASDAQ and S&P also were off. These losses are coming amid growing concerns about economic growth.
Tech-heavy NASDAQ plunged 4%.
Elon Musk's Tesla suffered a 15% decline, and tech darling Nvidia fell 5%, and Alphabet and Meta fell more than 4% on the day.
From mid-February, the momentum suddenly reversed. And then came Monday, which was the day of bloodbath. This is when the NASDAQ plummeted by 4%,